Hello, this is a video about downloading financial data. I think there's another video related to this, but this time we're going to try to use the analysis. Now, uh, let's just try to explain how this works. I found some yieldco names. These are these companies that buy mature renewable assets, or maybe some even non-renewable assets. Now, the interesting subject here is, can we kind of figure out what the cost of capital for a mature asset is from these yield companies? I suggest that the once a company is once a either renewable project or a normal IPP project is in service, the cost of capital should be very low. Now, I've read a little tiny bit about this, and there seems to be some crap that suggests that there can be some big growth. These are somehow growth rate stocks. What a joke. What a complete joke. The only way these things can grow is if they buy assets. Now, if they somehow get lucky and buy assets for costs that are, kind of below the true value of the companies. In other words, say the earned IRR is, I'm sorry, say the required IRR, the cost of capital is 5%, and they're buying an asset and paying enough in order to earn 6%, and if they keep doing that, then they can earn money. I agree with that. But that suggests they're kind of getting assets for higher than their cost of capital. Now, the way this works is, and it's been mixed, I have to admit. I'm really struggling with getting the format right. But the one thing we can do is put different ticker symbols in. And when we put different ticker symbols in, we can read from stock prices, combine the stock prices with this very nice data that, if it's correct, which I'm not sure it's correct, from Market Watch we can combine it with a historic income statement and balance sheet. Now, much of these don't have history. And then we can put one of these summary things from Yahoo that has all sorts of data on betas and dividend yields and PE ratios and EV to EBITDA ratios. When we combine it all, this is all going to be a bunch of junk right now. But we can extract financials on the tax rate, the depreciation expense, and the nice thing about it, we can get it all over time. And then we can put that together with some stock price data. And finally, we can do some data analysis. I hope we have the ending stock price, common equity, come on, price to book ratio, finally, ROE, PE ratio, and we can try to, from that, derive what the cost of capital is. Now, I probably won't be able to do it perfectly, but I'm going to try. Now, I've got to put kind of a template thing here. When we read all these things, it says read stock prices. Here I should stock prices for a ticker, and then we have read ticker code. Just a minute. Where's the rest of these reads? Ah, shit. Now there are a whole bunch of little macros and stuff in here. Just a minute. Read URL. So we're gonna find what our base book is, use the workbook.open, read this, and we go through code, and we read one at a time. We first read the stock price, then the other ones. And where do I put the range ticker? And then we have just a minute. Depending on what our code number for our URL code is, we name the sheet. And just a minute, just a minute, just a minute, just a minute. Read your application. Okay, read URL, just a minute. Where does the read URL come into? Clear sheets. Shit, sorry. Read everything. So we should be able to just look at that. It says read stock prices, but it's really reading everything. And it's not really reading stock prices. It's, you know, so let's reading ticker, and then let's put what the URL code is at least. URL. I don't have to say code, do we? And it's URL ticker. Okay. I hope that we have a range URL here. I'm almost sure. URL name. See, I got it wrong. So at least we can see which ones we're rating. This application.status bar shows you at the bottom. So I'm going to turn it on and then turn it off because, you know, after it starts reading, it'll take a long time. So I first press clear sheets to get rid of everything else. Now when we press clear sheets, nothing after the break sheet happens. That's a macro that goes backwards through the sheets and then deletes them. And then this read stocks we don't really want to do, and read one just would read one company, so we want to try to read everything. Okay, and see what happens to all of this analysis. So as analysis, all the data, and after we retrieve the data, then we'll go through this now. I wish I knew exactly what it's doing. Here's the URL code, and here are the URLs. Aha! So it's reading yahoo.com, and it's reading the statistics. Now, why it didn't read the other ones? Maybe I had a problem. Does it start it from the end? Okay, now it's taking a little bit of a long time, but once it starts, I promise you, it goes a little bit more quickly. Okay, here we're doing. Let's see. Oh, come on. Here, NYUL. So you can see down here what it's reading, and it does take a little while. Maybe if you have paid 50,000 for Bloomberg or something, you can get it to go a little faster. I don't know if you can really do that or not. And because the key thing is putting all the data together and interpreting it. Okay, it's still taking a long time. I have to look. Okay, and then it's reading another one. Alright. And okay. I guess. No, yeah, I have to check this. I probably put something wrong in here. So I'm going to put this on the website, and on my website I'll put it, you know, we have this thing called real estate downloads data from the internet. Just a minute. Proofs, blah blah blah. Oh, come on. Downloading multiples and perform regression analysis. That's where I'm gonna put it. really should be downloading financial ratios, okay? And I think this is just kind of as important as all these financial models. So I have to pause this for a while we wait for it to come back. Okay, now of course it didn't work out as usual. Whenever you do this corporate analysis, doesn't work out as exactly you planned. Here's after we got this summary. Um, here's the just a minute. Uh, I made a function here. I'm trying to remember what I did, but we found a match and index. Match the partial sheet E5. E5. Do I have to press recalculate? Just a minute. Where's E5? Okay. We're going to do this again, but we're going to find the uh, financials and all this for the various sheets, okay? So we have the net income, the diluted shares, the expense, pre-tax income, income tax rate, all the kind of stuff. You know, I have to fix these values a little bit. And it says which sheet it's getting it from. Okay, and then we have a summary sheet here. And well, let me just see. So this is match. Oh, this is the F4. We match the fiscal year. Okay, and then uh, I don't know what I just did. Excuse me for that. And then we can get the stock price here for each year. Now there's a whole thing with all the data extracts on the stocks. Okay. Only one of them really had a big history. The rest of them, you know, just have 2014 and 2015, so they don't really have that much. And then we have the data analysis. Now, of course, the data I really want, it has some things, the PE ratio here. We have that, but the PE ratio is all over the place. And I think these things really, it might be better. And it has the ROE, and then it has the market to price to book ratio. So the fact that the price to book ratio is above the above one and the ROE is over here suggests that the cost of capital is extremely low. Now, some people will say that the dividend yield really reflects the cost of capital if you basically assume that let me see, you assume that dividends are just about going to be constant. Uh, uh, or even decline. I mean, that dividend yield, which I don't have here, and I have some other stuff. Okay, so what we really want to do is make another sheet, and let's get the summary data. Okay, and now uh, this was we have the sheet names here, and we got that from 37. Just a minute. Oh, this one, and this was B52 and B52 in summary. So I'm going to cheat. I'm going to cheat because I don't want to spend way too much time on this one, and we'll put the this one for our indirect. Then we'll be able to find our indirect. We'll be able to use our indirect calculations. Okay. Now, once we have that, okay, let's just look at one of the summary sheets. We have all this junk in here, and I don't care about the junk anymore. What I care about is finding some of the numbers I really want. First one is, let's get the price to, where's the PE ratio? Okay. We have return on equity. Let's copy that one. Okay. Excuse me for being so slow. Perhaps we'll make a new window and then view and arrange all vertical. Okay, and we can put this one back to the. Okay, we can get the enterprise value. We don't care about that. How about the forward PE? Now, the only problem with this forward PE, of course, I say of course, is that we we have this date that might be different for different companies. Okay, so I'm not going to worry about that right now. We might have to later. That's why I put that thing called partial uh, match, where we just match forward PE without the rest of this shit. Junk, sorry. And then we put forward annual dividend rate and forward annual dividend yield. And again, that has some kind of little. Why did that happen? What in the heck is that? I don't know what's happening over there. Oh God. Uh-huh. And then so we have the dividend yield. Now the other thing I really am curious to see is get the price to book ratio. Look at this. It's higher than 1. Okay. So let's uh, see if we can put it here. Okay. And I'm just about to get a conference call, so I'm going to stop. And I think those are the main things I really wanted. Now, let's just get this silly little beta. Why the beta would be... What a joke. What a complete joke. For buying this stable kind of company with no earnings, you're going to get a beta of... What's this going on? Oh my God. Oh my God. I pressed some stupid button. Oh, you almost had to see me. That would have been a nightmare. Oh. Okay, so we got our beta having trouble copying and pasting a very advanced function in Excel. And now I'm gonna turn it off, and I think, is there anything else we really want? I've got the return on equity, cash, debt. I don't care about the rest of the stuff very much. Payout ratio, look at that. Why don't we get a payout ratio? Is that 300%, that payout ratio? That just demonstrates that they should be paying out all their earnings. I don't know if they really do. Okay? So we're going to now download these few statistics we really want from from uh, from our yieldco analysis. Okay, and now I've got to pause for a minute while I wait for my phone call. Okay, I used this partial match thing that I made. Turns out I could have used a regular match. And then I put the index in just for this first one to get the return on equity, the PE ratio, the dividend yield, and so forth. Dividend yield 1%, ROE 7.76%. Oops, I don't have my generic macros open. Where are they? Come on. And now we'll use the indirect function, Shift Control P. So this is a beta supposedly 1.2223. The whole thing, it just seems so inconsistent. And the market to book ratio way above 1. I hope I have that right. Now if we instead that we don't want to use this one here, so we can put indirect and take out this little sheet name with a little double inverted commas here. Press the F4 key 3 times and a little and sign, and put a little double quotes till the end and close it. That's shit. I made it sound so easy. I screwed it up. Indirect. Okay, I'm turning it off. Shit. Okay, I neglected to see that I had already put a double quote there. Now, unfortunately, since I think I have a different thing here, I have to do this again. Can I copy this? No, I didn't do it very well. Okay, and put this here. Oops. 4. There, and we go all the way to just the double B's. And put another one here and close it. So instead of making this, why is that? Instead of making this so utterly boring, I'm going to stop for a minute. Okay, I don't know how good a video this is going to be, but, well, whatever. So I added a couple of things. I had to use the old-fashioned math bit. And I added the dividend yield. Now you can argue that let's see, if the dividend per share is just going to be constant in the future, a dividend per share is going to be constant. Now, if it's going to grow by increasing the number of shares. So unless they, again, have this wonderful little game where they can somehow buy assets below their cost of capital. In that case, you could use the dividend yield as an indication of the cost of capital, simply that. Now, if we make another analysis, and here's what I'm doing. I'm looking at the ROE up here. Now, I want ROE to be on the x-axis, not on the y. No, I don't want to graph two different things. And the y-axis, I want the market-to-book ratio. Now we have an outlier here with this terraform. I don't know what the heck's going on here. Perhaps we can look at it. You know what you could do. Let's see if we can do this. See if we can do this one. I don't know which one we'll insert, but if I insert a where's the hyperlink? Current place in this document. and we want the derive sign. Okay. We could make a macro that just goes through that. And my question is, why is that market to book ratio so low for this company? Okay. The price to book ratio for TERP is 0.92. So I'm going to start swearing. My son said, why doesn't it have that thing on your Excel where you can go backwards? I don't know why. TERP some. Oh, this was the yield. I'm sorry. The market to book ratio is 0.92. Terraform Power. No, Terraform Power. What is going on here? I took the yield instead of the market to book ratio. That was pretty stupid. Okay, now here's the issue. So we could say the price to book ratio, the dividend yield provides an indication of the cost of capital. Now, if the ROE, and these are these miserable ROEs, and doesn't work quite right, because you should see a nice correlation, and we can't even see any correlation. But when the market to book ratio is 1, if the ROE is constant, the ROE should equal the cost of capital. So if we make a graph, we can't push this last one. I'm going to press alternate in F1, and then we get this, but we want to change the chart type and make it a XY chart. And we don't get our normal kind of thing where it goes up. But we can see when the market to book ratio is about 1, we get a ROE of somewhere between 2 and 3%, suggesting that there's something funny going on here. Either with my theory, which is an obvious theory, which it says that if the market to book ratio is equal to 1, okay, so this line should be somewhere around the cost of capital, and this says even if we take the high side, we get a 3% cost of capital, and that suggests that they cannot maintain these dividend yields, which I suppose if you look at the past, it has happened. If the market price comes down, although, if the dividend comes down, then they can maintain it. And we looked at these betas. They told us zero, absolutely zero information. And I suppose we could look at the PE ratio. And so if we put the PE ratio, now let's use this kind of thing that says the formula for the PE ratio is 1 minus G over ROE divided by K minus G. Okay, and then if we rearrange that, we can say PE times K minus G equals 1 minus G over ROE. And then we can kind of subtract out so K times PE equals 1 minus G over ROE plus G times PE. So then we can put K equals PE. 1 minus G over ROE plus G times T E, whole thing divided by P E. Okay, now I'm going to make an assumption, which I think is a reasonable assumption. Some people, the highest the growth rate could be is 0, and we'll put a 3% growth rate in here. Okay. Whoops. So, let's copy that. This is too shitty. Is that? Let's do it. Okay. How about even wider? Come on. And let's, let's say it's 3%. And G is 0. And then we can take our PE ratio and put 1 minus 2 F4 divided by ROE. Okay, excuse me for that interruption. 1 minus G over I plus G F4 times the PE ratio over there. Okay? I'll just stop. That's not very interesting. I think we get if we have no growth, we get a 1. And then we divide that by the PE. Now we get a 7%. Okay. How come this one even has one? So we get somewhere ranging from 7% to 3% to 5% ROE. Now if the growth is minus 2%, probably reasonable. Okay. Then we get a higher rate, let's say it's 2%. And so let's say 1%.
Okay, thank you.
And I get something like let's leave it at 1% to get that. So I think you could make the argument that the cost of equity for the yield is extremely low. Okay? Without using the beta. You certainly couldn't use the beta. That gives you 0. So, okay. Market to book ratio. I don't know. I love that one, but it didn't really work very well. Dividend yield. It's just an annuity. If we get a pure annuity that just lasts for a perpetual period and doesn't grow, that's the cost of capital. If it grows, we would actually have to increase the cost of capital above that. Okay, so that's what the market is telling us. Actually, that's what dividend yield is. So, okay. And we can use the same road. So, remember our formula is the price equals the dividend I guess if we're really fancy, we can times 1 plus G divided by K minus G. So all we do is like the price divided by the dividend, which is the dividend yield, equals 1 plus G K minus G, and price divided by dividend. Look, my algebra is so bad, sorry. K minus G equals 1 plus G. And say, why is this taking so long? It should have been a lot easier. Okay, and we're looking for K out, so price divided by dividend times K minus price divided by dividend times G equal 1 plus G. I thought the formula was just the dividend yield plus the K. What did I do wrong? So, to get K, we put price divided by dividend times K times, oops, yeah, times K equal 1 plus G plus price divided by dividend times G. And finally, I'm sure I did something stupid here. Shouldn't have left this on there. I can't copy with all these functions for some reason. Okay, divide that by price, divide by dividend. Now, why is that? What did I do wrong? Okay, let me try it again, just because I'm afraid I did something really stupid, but it's okay, you can do the thing. God. Let's just, price times K minus G equals dividend times, I'm using different signs, 1 plus G, okay, K minus G equals dividend divided by price, which is the yield, times 1 plus G, and then K equals dividend divided by price times 1 plus G plus Y. That's the obvious one. I think the other one will give us the same answer. I did it stupidly because I haven't done it in so many years. People call this the stupid Gordon model. Okay. Put that formula over there. Okay. Dividend yield forward, which means I don't have to multiply it by 1 plus 3 plus the growth rate. Let's put that on. And thus we stop there. So, whoops. Ah, shoot. Control D, so that I don't have this one. You know, I can do on this one average Okay. Okay. Let's put median. So again, we get interesting differences between these. Let's say the ROE is 5%. Does that even affect things? Yeah, a little bit. Okay. Maybe so we got 5 to 7% for the, and then we can use this expected IRR out of the calculation. So I'm gonna stop there.